Hey guys, today I want to talk about the importance or unimportance of interest rates when making decisions about business acquisitions. Okay, I'm Walker Deibel, best-selling author of Buy Then Build. I've been buying and selling companies for 20 years and helping dozens of other entrepreneurs do the same. I'm also creator of the Acquisition Lab, where I get a lot of these questions. And currently, it's like, Walker, you've been doing this only during decreased interest rates environment, and today it's an increasing interest rate environment. Well, that's only partially true because I still own multiple companies today that I've acquired that currently have loans on them as well. So I've got a real life case study, okay, that I want to share so that we can quantify the sort of risk associated with interest rates and try to weight the importance properly in your decision process, okay? So here's a real life example. This was not a business, but it was a building, okay? And I think that it makes an even better example because a building in a tertiary market, the appreciation value is like zero. So it actually reduces or eliminates a lot of variables that you might get in an actual business acquisition. It makes a good example because this case study draws it all down to just the simple math, okay? Simple, follow me. So here's the deal. I own a manufacturing company, okay, and I had an opportunity to buy the buildings that it was in for a total of $775,000, okay? $775,000. There was really two options that the bank was giving me, and this was 1 year ago, I'd say. So we had option one. All I had to do was put down $25,000, okay? With a 25-year amortization SBA loan, okay, on a building, and the rate is variable, okay? And so the thing is that obviously we were starting to see that interest rates were probably going to go up, and so we were sort of also considering option two, which was it had a fixed rate, okay, so it eliminated that risk for us. And it had a 20-year amortization instead of a 25, okay, so slightly different. You could say that's better or worse depending on how you think about it. It required $200,000 down, okay, infused into it. And so the thing is, you know, what do? Do you put more down and fix the rate, fix that risk, or do you put less down and open yourself up to it, okay? So let's kind of run through some of the math in terms of I wanted to do this option, and my partner wanted to do this option, okay? He was terrified of interest rates, and I didn't blame him. We all sort of acknowledged that this was a problem. But here's what was going on. So we were paying at the time a total of $7,500 per month in rent, okay? I can't do that in my head, but that's right about an 9% cap rate, okay? That's what we were paying in rent. And so either one of these options was going to lower the amount that we were paying, right? So in the option number one, which we could call max leverage, ML, and this one we could call fixed rate, or FR, okay, just for fun. Okay, so in the max leverage scenario, our new rent was going to be $4,606. Okay, so quite a reduction from the 7,500. In this one over here, it was going to be, and this assumed, by the way, a slightly high rate of 5.5% compared to the sort of, really it was going to be like 4%, but I want to use like 3% just as an extreme example, okay? So if we had a 3% rate, it'd be $3,189 a month, okay? So I can pay $200,000 and pay $3,000 of $3,200 a month, or I can pay $25,000 and pay $4,500 a month, okay? So the thing is that when you annualize this out, right, this comes to a savings of about $17,000 a year if I switch to the fixed rate, okay? Now, look, I would rather save $17,000 than get a stick in the eye. That's a lot of money, okay? But the truth is that since this is a business, okay, that extra savings, in theory, turns directly into profits into our company, okay? And so unless we can reinvest it, that 17,000 will get taxed. And so in reality, okay, if we truly save it and it becomes profits, you're talking about, it's about $9,800, okay, post-tax dollars per year, okay? It's significant. Let's just leave it at that. So here's the thing, simply by reducing our rent from $7,500 to $4,600, I'm actually already saving $35,000 a year. So I'm saving $35,000 a year just by buying the building, assuming this 5.5% stays the same. I understand. Stick with me. So I'm already saving $3,500,000. I'm investing $25,000, which means by maximizing my leverage, okay, even though I'm taking the risk of the variable rate, I'm getting a 1-year payback on that money. Okay, even if this is taxed, it's say 35% plus state. I'm making a 1-year payback, okay, on that investment, right? So that was kind of interesting. That same savings over here turns out to be about 7.5 years, okay? So my initial investment, I get returned in 1 year over here. Option 2, I get safety of protection against interest rates climbing, but it's going to take me 7.5 years just to make my $200,000 back, okay? And that's kind of interesting, okay? And once you start thinking about the fact that those get taxed, what's the real rate, right? Okay, so the first point, 1-year payback versus 7.5-year payback, okay? Next point, equity buildup, okay? In this over here, I'm essentially taking $25,000 and assuming 0% appreciation on the building over 25 years, okay? I'm magically making the 25,000 turn into 775,000, okay? Pretty good, pretty magic. In fact, that equates to a 13.75% year-over-year return on the $25,000, okay? That's compared to, over here, I'm magically turning 200,000 into 775K. And so that is about a 6.7% annualized return, all right? And so the thing is, I started thinking about, okay, look, that's great, Walker, but the risk, the interest rates, okay? So this option 1 wins on return of your investment. It also wins on equity buildup and ROI on original investment to what you're actually getting, okay? There's a small amount of increased ongoing expense to the tune of $17,000 a year, okay? But let's talk about the risks of each side here, okay? The risk here is that rates are going to go up, right? We know that. This is the whole reason why people get scared of variable rate loans. Here is the mortgage rates over time, okay? This is 1971 through 2019, and we know that they went down from here, okay? As you can see, it peaked in 1981. And in 1981, mortgage payments, the interest rate on a new mortgage was over 16%. I think it was 16.6%, okay? That's high. That's really high. But the thing is you can also see that, you know, when you went to 16%, it didn't happen like overnight, okay? It took a little time, all right? And so there is sort of a third strategy that we can kind of introduce here, okay? But the point is that when you actually, 16.68%, when you actually consider why does the Fed increase interest rates? They increase interest rates because of inflation, okay? So they're trying to slow the amount of dollars that's going into the economy and the use of those dollars. So they want to increase the cost of capital so that people are doing less things. Interesting. But anyway, so we're not going to go on that tangent, but the point is this, is that if inflation is so extreme that we end up going to, at this time we were at, maybe a 4% over here on the fixed rate. I'm using 3 in this example as to overemphasize, the gap. But the thing is that if we were in a situation where we were going to go from a 4% sort of mortgage, okay, to double 8%, to, even 20% higher than that, 10%, okay? At a 10% interest, we would be paying $6,000. So instead of $4,600, we'd be paying $6,815. I think that's a 15 out of 95. I can't read my writing, but anyway, something like that. So here's the point. If inflation is going up, okay, this isn't going to happen overnight. This is going to take multiple years to get there. Could it happen in a 25-year span? You know what? I think if we asked everybody on the street today, they'd say yes, okay? But maybe it could happen. But here's the point. If it goes all the way up to $6,800 a month, what's happening? Inflation. What does that mean? It means dollars cost are not going as far. What does that mean? It means that our supplies cost more. It means that the prices that we're charging cost more, okay? And so it also means that our building is all of a sudden worth more. So the 6,815 will probably feel like 4,600 because of the cost of capital that's going up and the increase in prices of the building, of the materials, of the prices we charge. Okay, so the truth is that life is variable, and that as interest rates go up and as all these things are going to cost more, okay, the truth is that the dollars are going to feel about the same. Imagine, we just looked at a chart in 1971, okay? Would you pay 16.5% interest on dollars if they were worth the same amount as they were in 1971? Yes. We're not going to dive into that, but the thing is dollars were worth way more in 1971 than they were now. Okay, and they're probably worth more now than they will be in the future. So the truth is that 68.15 will probably just feel like the 4,600, which, by the way, is a significant cut of $35,000 off of what we're already paying in rent. Okay, so we're capturing most of that, and so that's the risk. And so the point here is that option one probably has the lowest investment and the highest return. Okay, with, I'll be unpopular for this, a de minimis level of risk being accepted, okay? It's volatile. You might lose some sleep. It might get tight for a minute. Yeah, it's business. It's entrepreneurship. That's how it happens. Over here on the fixed rate, what is the actual risk that we're taking on? Is it that interest rates are going down? No, it's not. Because if interest rates go down, what do? You just say, oh, they've gone down enough and now it's worth it for me to refinance so that I can save even more money. This is incredible. Okay, and so the thing is that if interest rates go down, you just fix it, right? So if you're protecting yourself from interest rates going up, but the risk isn't that they go down. The risk is what else can you do with the $200,000, okay? Now, if you took, okay, the difference of $175,000 between these two, all right, and just put it in a conservative portfolio in the stock market. It's been going down lately, if you've noticed, because interest rates are going up. But here's the thing. In a conservative portfolio over the 20-year period that you're going to have it invested in this building, okay, it would turn into $1.15 million, okay? So you're going to get, even in the 7.5 years that it's going to be tied up for you to get your original money back, you would have an 82% gain in the stock market at the same time, okay? So listen, the thing is that if you use this over here, and you've got the $175,000 anyway, instead of putting it in your building, you just put it in a conservative stock market investment, and you're going to gain not only the $775K at zero appreciation, okay, but you're also going to gain another $1.15 million just being in the stock market, okay? Or maybe you're in real estate and you're going to get maybe a 10% cap rate on some building somewhere like this one. Or maybe you're going to buy another business with that money and actually get 30% returns, right? And just multiply this whole equation over and over and over, okay? So the thing is that it's the opportunity cost. And so what are you gaining? What are you gaining over here? You are losing the ability to turn $175,000 into basically $1 million in a different investment. You're losing and you're gaining $17,000 in protection. $17,000 a year for protection. You're gaining $17,000 a year with a slow payback, okay? And what are you protecting yourself against? Increased rates. And as you can see, increased rates, are going to save me in this equation $17,000 a year. I don't care. I'd rather get the 13.75% growth on the original investment. I'd rather get my original investment back in 1 year. And here's the third strategy, okay? There's a third strategy, which is the following. You buy the building on option 1, okay? Then you do not reduce your rent. Do not reduce your rent. Keep it at $7,500 a month, okay? Then in 3 years, you now have 25% in equity in the building, which allows you to refinance at a fixed rate, okay? And so as you look at the chart of interest rates over time, they always seem to be about 6-8%, okay, for these mortgages, okay? That's sort of like the average over time. And if you are running a business model that doesn't work at a 6% interest rate as your cost of capital, then you shouldn't be doing that anyway, okay? And the difference between 6 and 8%, 2%, is probably not, it really shouldn't be the make or break. So anyway, listen, here's the point, is that I think that we overemphasize the risk of interest rates going up. And in fact, I think the opposite is true. I think that when interest rates are low, okay, we are willing to pay more for the same exact asset. I look at houses in my neighborhood, and it's one of these where the price of these homes is double what they were 3 years ago, just because interest rates are low. And that doesn't make any sense, okay? There's no more supply, it's just that demand has increased because everyone has this cheap money, okay? Think about that for a minute. Why would I pay double for the same asset, okay, when I can just wait for interest rates to go up and I can pay a lot less, right? And then use this strategy for low cash down, high equity buildup, and really a low cost of that risk. So the risk-adjusted return is significantly stronger in option 1. Therefore, I'm not going to say don't fear interest rates. There's lots of variables that go into buying a business, but don't let interest rate environment be the single thing that's keeping you back from the freedom that comes with business ownership. Thank you so much. If you're buying a business in the next 6 to 12 months, feel free to check out the Acquisition Lab. We are the premier accelerator for acquisition entrepreneurs.